Technical defaults among Philippine conglomerates rarely begin and end as financial matters. In a world shaped by complex family ties and legacy reputations, every loan becomes a signal, the kind that reaches beyond spreadsheets into boardrooms and inner circles. The story of ABS-CBN's defaulted loans draws in three of the country's most influential families: the Lopezes, the Aboitizes, and the Ayalas. At first glance, the numbers, about 12 to 13 billion pesos in consolidated debt, are manageable for their lenders, Union Bank and BPI. Yet, the true weight of this situation is not financial alone. It reaches into how these families treat one another when crisis interrupts routine. ABS-CBN remains technically in default. It still services interest payments, but breaches in loan covenants, triggered by the loss of its broadcast franchise and weakened balance sheets, force banks to classify the loans as current and potentially demand early repayment. Temporary standstills have given way to short, uncertain extensions. No lasting refinancing is in sight. For bankers and lawyers, technical default marks a change in risk, greater regulatory scrutiny, stricter boards, and watch-listed accounts. These signals linger in institutional memory, and patience naturally thins as time stretches. But in Philippine family capitalism, debt absorbs personal undertones. Union Bank and BPI are not just creditors, they're pillars of family-owned conglomerates, with histories interwoven through decades of joint ventures and capital partnerships with the Lopezes. This background turns ABS-CBN's prolonged limbo from mere inconvenience to awkward strain. Optionality, the ability but reluctance to resolve, becomes a source of friction. Complicating matters is the first-gen paradox. The Lopezes, through First-Gen Corporation, recently sold much of their gas business for 50 billion pesos, unlocking fresh liquidity. Legally, this cash is siloed, but relationship banking is about perception. If Lopez capital flows to renewables rather than resolving group defaults, lenders take note. Quiet questioning of group behavior soon grows louder. The risk now is a gradual cooling of alliances. Further Lopez-linked borrowing may attract stiffer terms. Banking goodwill, once extended in crisis, is slowly withheld. For institutions like BPI, caution post-merger becomes policy. For Union Bank, after its Citi acquisition, leniency is even riskier to defend. In the end, the matter is not simply ABS-CBN's survival. It's about what message the Lopezes send, that family credit can rely on family capital, or that rational distance will prevail. Because reputations in Manila endure longer than loan maturities, and how banks interpret this episode will shape future deals, pricing, and trust among business dynasties far beyond today's balance sheets.